Steve, where have you gone for a stock to double down on in December?
I've gone for big tech also, but it's quite reduced in size, just as much as Amazon over the year, and it's kind of well, we was going to do it last week, but we ran out of time. But interestingly, it's down about 9% today, and it's down today because Laura Martin of Needham, she's quite bearish on Netflix. I've seen quite a few of her posts on it. She decided to post a note that's saying Netflix is giving money back to advertisers because it can't deliver the adverts to people, which seems strange when the advertising business has only really been live for 6 weeks.
I was going to say it launched in November, right?
Yeah. So, and if you can't deliver adverts to people, then you just run the campaigns a little bit longer. So that seems really, really bad. So I thought, just out of pure interest and not devilment, I would just have a look at Laura Martin's tip ranks. So she so tip ranks, just for anybody who doesn't know, if you see an analyst and you think that's a very stinky review, I don't really like that, you can search for them on tip ranks, and it tells you really how well they're doing. So and it basically takes all of their if they're upgrading prices or downgrading prices or telling you to hold or whatever, and it tells you how they've done since they started making these recommendations. Laura Martin, I said, was a 0.2 out of 5 rated analyst. Actually, Casper corrected me. She's actually 0.16. They're rounding it up. They're rounding it up from like the lowest possible denominator as well. She's a 0.16 out of 5 rated. She covers 56 stocks and has a 36% success rate. So that is, throwing darts at a dartboard. Only 36% of them actually hit the board. Interestingly, Steve, I just had a quick look down here, and I think the worst one of her ratings is she has a $180 price target on Peloton, which is a 1,470% upside. So if you don't mind, I'm going to have a go at analysing Netflix again myself.
Sure. Thank you for answering the question, though, of who's still buying Peloton for us. Normally the answer to this kind of thing is pension funds or something, but it's because we're asking who's buying bonds when the yields are at 1% and inflation's at 5% or something like that. You might be wondering who's still buying Peloton stock. Well, presumably the analyst with a $180 price target on it.
Yeah, well, I mean, maybe Bill Ackman, who knows? He sold Netflix pretty quickly. Maybe he thought, oh, well, this Peloton's got a big a big upgrade. Maybe I'll go there.
Sorry, do tell us about Netflix.
Right, I'll start really quickly with just a little bit about what Netflix actually is. I think this is almost pointless, but it's worth just covering the very basics. So Netflix is a flat fee, somewhat flat fee, I guess we should say there, because they keep raising the price. But it's a monthly subscription entertainment company which opens up a large variety of entertainment content to the user. So this will be things like documentaries, TV series, movies, and more recently things like games. About 65% of this is original content, and the other 35% is bought in. It's wholly web and app delivered, instant access, fully bingeable, nothing gets held back, no time-gated content releases, and this has led to them having industry-leading low churn rates, and that's the rate in which people leave a platform. It's about 3 times less than their competitors.
That is interesting to me. I knew all those things about it, but they sort of don't really fit together in my head in a certain way. I sort of think bingeable content leads to less churn is sort of surprising for me. I would have thought kind of having people hanging on waiting for the next episode was a sort of more natural way to go. If it were me, I think I'd watch the whole thing and find there was nothing to watch and probably leave. Any ideas on why those go together?
Well, the reason why I think that happens is because there is really a lot of people have more than sort of 45 minutes to watch a TV show on a night. A lot of people can fit in 2, 3, or 4 of them. So if somebody is going to release, one show a month, one show a week, for a month, you might as well wait a couple of months, then sign up to the program and watch them all in one go and save yourself a month's subscription. And that's a problem with the content providers that don't have a lot of content. Netflix has a lot of content, and by the time you've finished, one series, there's another series ready to go. They have a very good recommendation engine that knows what you've liked, especially if you feed it with the updates. It will start to recommend things, that are of a similar ilk to what you've just watched.
Okay. That makes sense, I guess. Yeah, sorry. Carry on as you are.
Okay. So the business operates in 190 countries. Steve, do you want to name them?
Yep. England, the USA, Canada, India, Australia, New Zealand. How many is that? 175? France, Germany, Poland, Russia, maybe. Hang on.
Probably not anymore.
No, probably not anymore. Iceland, Greenland, Norway, Denmark, Sweden, whichever country Paul's currently in, whichever country Sam Bankman-Fried is currently in.
Is jail a country?
You probably get it in jail, I reckon, but...
So, 190 countries. It actually produces content locally, so actually for that country, in 40 of them as well. So it's probably a little bit bigger than you think. So it's going to end this year with about 230 million paid subscribers. About a third of those are in North America. We like that because they're high ARPU, average revenue per user. And this amounts to about $30 billion annually in revenue. So it's founder-led. We like founder-led companies generally. Its CEO, Reed Hastings, founded the company in 1997. Back then, it was a DVD by mail company competing with Blockbuster. The irony of this being they have now made a TV series called Blockbuster, which is really, really cold. But yeah, they were competing with Blockbuster and Love Film, which was acquired and retired by Amazon, if you remember that. In 2007, they switched from DVD by mail to streaming only. In 2010, they broadened horizons and entered markets outside of the US. In 2013, they began heavily focusing on homegrown content and IP rather than buying it in. And I suppose we can now add that in 2022, they've swapped from being a monthly subscription to being, or to having an ad-supported model, which creates a whole new marketplace and a whole new revenue stream for them.
Yeah, this is an incredibly successful pivoting company, isn't it? It kind of feels to me like a company that's just about reaching maturity. It's been in sort of growth mode for quite a long time. We've been looking at subscriber numbers and that kind of thing rather than cash flows, even though it's kind of been mature about sort of 3 times over. It's a kind of born again thing in the streaming market.
Yeah, it is, and the market as a whole is really, really vibrant as well. So in the last few months, the streaming market has finally overtaken broadcast television as the most watched medium in terms of watch hours, and this is still only in the mid-30s%. So I mean, potentially we're still early in this transition to streaming. So this obviously has led to a large rise in the competition, and I think we can fairly say there's varying quality and varying approaches. There's been a bit of consolidation in the sector as companies have kind of doubled up to try and help themselves be able to spend the amount of content that places like Netflix and fair play to Disney Plus, they're also offering. Netflix is the only company that's spending close to $20 billion dollars and making a profit. In fact, I would say apart from Disney Plus, they're probably the only ones who could at the moment.
Yeah, it's quite a kind of congested space, this, isn't it? It does look like a vibrant space, the streaming space. It does look quite busy as well, and there's kind of a lot of players that want a piece of that action in terms of sort of Comcast and HBOs and various other things. So does that mean this basically comes down to a race for who's got the deepest pockets to outlast everybody else?
I mean, potentially that is the problem here, but Netflix will tell you that they're happy with what they're spending at the moment. So it looks like 17 billion is about the ceiling for now, where they think, people are going to struggle to spend this amount and buy the kind of shows that we're going to buy. Disney have got a lot of IP that they can develop. They don't buy in as much kind of content as what Netflix are doing, or they don't originate brand new IP in the sort of way that Netflix are. So, Disney is a different beast spending that kind of money. But it'd be interesting to see, and I mean, there's been consolidation in the sector, so it'd be interesting to see, where what happens next here.
Yeah, these are quite big numbers we're talking about here, spending sort of 17 billion, 20 billion on content. These are sort of big investments, I guess. I mean, how does that kind of translate into, where's the return, or how does the return kind of look in terms of revenue and so on?
Yes, so I mean, we're looking at $30 billion in revenue. That's about $12 a user. Outside of the US, you're looking at about half of what North American ARPU is. So there's room to to frog boil there, which is probably my new favourite saying. So when Netflix are confident that people in these countries will pay more, they will be able to squeeze a little bit more money out of people. Obviously, ad-supported will come along and support that. So in terms of like how it works out, so content spends about 60% of revenue. Marketing sales cost is about 6.5% of revenue. What they spend on their technology is about 8.5% of revenue. And other costs make up about 5% of revenue. So roughly speaking, we're looking at an EBIT margin of about 20%. Free cash flow ends up being about $1 billion this year. The delta between the two is the Netflix has to pay up front for its content, so it constantly drags on free cash flow. Tech spend here is pretty low, though, and this is because Netflix builds nearly all of its own software. Its two sort of key software components are something called Branch Manager and Open Connect. Open Connect essentially helps an ISP localize Netflix's traffic through its own 17,000 server network. So this reduces lag and it increases the response time, which is why you find that the Netflix app is usually very, very good. You very rarely have any kind of failure on it because it's running on purpose-built software. Branch Manager, you've probably played with this, but I bet you probably didn't know you had. If you've watched the Black Mirror interactive episode Bandersnatch, where the choices you made in the program actually affected the storyline, so it was like watching a film, but you had to play with a remote at the time. This was all done through Branch Manager. Netflix has actually quite a few of these sort of like choose your own path style content, and it runs all of this on its own hand-built software. So also in this in this cost is actually all the localization of content. So Netflix really does spend quite a lot on things like quality subtitling and dubbing and localizing for a global audience. So just quickly, speaking of content, co-CEO Ted Sarandos believes that the content spend is about right, he says. So the question really now is, like, does Netflix continue to drive its revenue by growing both its ARPU and its membership whilst keeping a lid on content costs? Because if it manages to do this, the figures on the bottom line should rapidly accelerate from here.
Yeah, they will. It's reaching the point where it gets what we call, because it is, something called operating leverage then, right? So as your kind of revenue grows, your margin grows with it, which is something that often feels like something you want from a business. You want your growth to kind of, especially in a kind of stock that's in growing mode and starting to convert over to cash here, you want it to be the case that the growth kind of is bigger the further down the kind of income statement you go on these cases. Make it once and then kind of ship it out feels like a sort of operating leverage model, right? It doesn't cost you anything more to add a new subscriber, or not much more to add a new subscriber. So you pay once to make the show and so on, and then send the thing out quite a bit. That can be a really powerful thing when the company's growing, right?
One of the models to look at when you think about this in terms of, people thinking that subscriber numbers is topped out is that Spotify is currently nearly double what Netflix has. So, I mean, they have an ad-supported tier, they have a free tier, so there's obviously going to be an element of people who were prepared to use that service. But if Netflix prices the ad-supported tier correctly and people think it's a fair service, then there is a scope for that area to be quite broadly built out. The other thing I'm going to say is, and I'm going to put my neck on the line here, is that I think they actually have some pricing power. And I was very wary of making the statement before seeing growth return on subscriber numbers, but I am a bit more confident now. I think the dip in subscriber numbers, like we've seen at the beginning of the year, was just growth pulled forward over the pandemic, and this is people having absolutely nothing else to do, and it led to outsized 2-quarter churn, which I'm betting is just a one-off issue. So Netflix is certainly indicating this is too. They're projecting over 4 million ads in the next quarter. So it looks quite positive to me.
Yeah, and I think this is something that makes a difference for what it's worth between Netflix and Spotify. And I feel more positively about Netflix than I do about Spotify. I'm not sure Spotify pricing power, I'm less convinced it's there. The stuff that you find on Spotify, and I get they are trying to find differentiated content with podcasts. Hi, anyone listening on Spotify, by the way, and so on. But broadly speaking, I think of Spotify as a kind of music listening platform, and music is in many, many ways a commodity. I'm looking for songs, I'm looking for artists, and I don't really care upon which platform I find them, whether it's Spotify or Apple Music or Google Music, if there is such a thing. I'm not sure that there is, but I think Amazon might have a music thing. Put this way, I don't really care kind of where I get it from here, because the product is basically undifferentiated. Spotify are trying to correct that using podcasts. But In the case of Netflix, they produce their own content, therefore they have a product that is different. You can think it's better, worse, or otherwise, but there is at least a point of differentiation there which makes them not a commodity in the way that Spotify is. So there is a good sense in which it makes a reasonable person might have multiple kind of TV subscriptions because they're not just watching the same thing on all of them, even though there'll be some overlap, versus something like music, I think, where it's a different sort of proposition.
You got to remember, Spotify are building out the proposition as well, so they're also doing audiobooks now at the moment as well. So they are trying to be everything ears, aren't they? So that'll be particularly interesting. But the question that you had at the beginning is a stock to double down on, and this is why I think you should double down on them. So Netflix are perennial sandbaggers. So they always go a little bit under guidance where they tell you this is what we see, this is what we're seeing, but really this is what we're seeing. But we're just softening it down a little bit so we can beat it quite comfortably. And I think this is one of the best content slates that I have seen for Netflix in a quarter, and the best content will drive more subscriptions. So just to quickly run down it. Wednesday has been released. It actually got a lukewarm critics reception, but the user score on IMDb was 8.5 out of 10, and Rotten Tomatoes give it a really, really high score too. It's actually now on pace to be their second most watched TV show ever. In this period, they've released All Quiet on the Western Front, 1899, who made the show Dark. This was a pretty critically acclaimed show. Troll. And they've recently got Glass Onion, which comes out, I believe, next week. They've stolen this from Lionsgate, and Lionsgate are so mad that they have lost this series that they're refusing to show the previous movie on their own streaming service, and they will not license it out to anybody. So Netflix actually gave this Glass Onion a limited release in cinemas, so they released it in about a third of US cinemas for a week only. This actually generated $15 million in revenue over, I think it was actually a 5-day period. And I watched an interview with Reed Hastings, and he let out a wry smile when he was informed that it could have made 3 times that amount if he'd just let it run a few weeks more. This was purely for marketing purposes. Netflix know they've got a cracking film on the hand. It's by Rian Johnson, who did quite a lot of the recent Star Wars films. They know they've got a cracking film on hand. It's got Daniel Craig as the lead actor in it as well. So they know this is going to be a hit over Christmas. And it's got a decent bit of hype behind it now. And then lastly, I mean, let's not forget that there's the Harry and Meghan documentary, which no matter whether you care about this or not, and I would argue you shouldn't, it has attracted a lot of eyeballs. It's had over 80 million hours watched already just on the first 3 episodes that came out. I believe the others came out either last night or today, the rest of the series. So it's Netflix's biggest documentary launch ever, and I think it's going to drive a lot of subscriptions.
Yep, you said whether you care about it or not. I don't, but I also think that people just like what they like in this context, and I don't think my preferences are any more or less worthy than anyone else's. Absolutely fine if people want to watch that kind of thing. Just a couple of quick things there then. So regarding Wednesday's reviews on IMDb, sounds like your friend Laura Martin dreams of an 8.5 out of 10 rating of this in this kind of way. More seriously though, content, as far as I can see, is 1, the most important thing, and 2, the most impressive thing about Netflix. The titles it's managed to build out to differentiate itself, back to the point I was making before a little bit, have been really, really impressive, right? There's some that can kind of run and run. It feels like Sex Education. Always build out another series of that and just keep that running for however long, as well as some that kind of can't. It feels to me like Queen's Gambit is sort of a one and done type of show, but it's been really impressive seeing these kind of titles and seeing these kind of titles work as well as they have. Some obvious ones and some less obvious ones.
Yeah, definitely. And I mean, if you were looking at those shows on the outset, you would see back in the days of terrestrial TV, I don't think Sex Education would have got onto terrestrial TV. I don't think that would have got a deal. And Queen's Gambit almost certainly wouldn't, even though that turned out to be a fantastic piece of TV. If you were saying, I want to make a show about chess, and I want to put it on, BBC primetime, they'd have gone, absolutely not. get out of the office. So it just kind of shows you that these streaming companies have come along and they've added a lot of things to the sort of quality of the entertainment that we watch. But just quickly, Steve, I'll move on as well because we've talked about content slate. I just want to quickly touch on the ad-supported. So ad-supported is launching in 14 territories. These are big territories. They represent 75% of the world total ad spend. We know that the pricing on the ad tier is $7. The ad load looks very light, 4 to 5 minutes of adverts per content hour. That's about 4 times less than what you would normally see on your TV. The theory is that this could lead to a drop in ARPU, although Netflix are actually indicating to us that ad-supported is pretty much net neutral, and in some territories is actually going to be positive to ARPU. So now imagine when they crank up this ad load. The lower entry price should also expand market reach to more cost-sensitive customers, the sort of people who would like Netflix but have maybe been waiting for this ad support to come along. Netflix have also indicated that, just as another further point, there's about 30 million homes in the US and Canada who aren't paying for the service. They're just piggybacking on another paying user's account. In putting a stop to this, Netflix hopes it will convert some of these. And I mean, let's call them as they are. If it converts just one of these freeloaders into a paying member, that's a positive. 10% conversion is huge growth. Another 420 million on the top line. If it converts half of them, it's 2.1 billion on the top line.
Interesting stuff. I mean, so not to go all kind of Laura Martin on you here, converting people, does that take the kind of... well, two thoughts. One, does that kind of take the audience away from the ad tier and make it less attractive to advertisers? Number two, could they get round this by just appointing you to run 20 ads in every ad break for them?
Yeah, that would be accident. Yeah, that would be an accident. Yeah, our ad load was not 4 to 5 minutes per hour in the in that previous.
No,
one.
it was 4 to 5 minutes per minute, I think. But
yeah. Hopefully, I remember to do that this time. But but yeah, I guess. Look, I don't think it does. I think making people create their own accounts is a great thing. These people are not on the ad tier at the moment by virtue of it not existing. So if they want to get their own account, if they like Netflix, then they're going to have to create their own account. There's no bones about it. And if they don't like Netflix and they don't watch it, then what's the damage? I don't really see the point. I think if Netflix even converts a small amount of these people and the rest of them, unfortunately don't get access to Netflix, they just become potential customers later down the line when Netflix does release that series that they originally wanted the Netflix account for, or an updated version or a spin-off or something. They become potential customers, and that's just a good thing.
Yeah, so, I mean, beyond the kind of basics of streaming, other revenue streams here? This feels like kind of content is important and so on. Merchandising, think Disney and so on.
Yeah, so, I mean, I listened to a couple of interviews when Reed Hastings was talking about sort of pivoting to making original content, and he got told that IP takes at least 10 years to actually start to get a foothold, and we're just getting to that 10 year now. So, I mean, you're going to look at things like games makers or toy makers like Mattel or Hasbro, even merchandise makers would be happy to pay for some of Netflix's content and transform it into other items. There's not a lot in this at the moment because, like I said, this IP is young. I would expect more of this, and maybe more of it to happen on Netflix's platform directly, but this is as Netflix matures.
I was in a Blackwell's the other week and I saw some evidence of this already starting to happen. I was sure I saw a Queen's Gambit board game, and I went back and checked this before we kind of put this together, and just to make sure I wasn't going completely mad here. And when I googled Queen's Gambit board game, one of the things that kind of came up as a suggested question or a commonly asked question of, is the Queen's Gambit board game just chess? And I think the answer is no, it isn't. It's published by a company called Mixlaw, I think, which I don't really know of very well, and I haven't seen how the game works, but I mean, that seems to me to be clear evidence that there's interest in this kind of thing and that they could maybe license this out or something.
Yeah, and I think there could be more of this as it goes on. I mean, like The Witcher, if we could have kept Henry Cavill in that place and it wouldn't start to be a terrible show under Liam Hemsworth, that could potentially have spawned off a whole... I mean, it's got a whole universe behind it. I think there is another Witcher show coming to... a spin-off show coming to Netflix over Christmas as well. So that could have spawned off a whole list of things, from board games to toys to whatever, really. But,
Squid Games, Dharma, all these kind of things that lend themselves to Christmas games.
Yeah, Dharma would be a wonderful Christmas game. Yeah, absolutely. Squid Game's an important one, though, because this we're talking about localized content here. We're talking about something that was made for the Korean market, and the power of Netflix's localization, trying to bring it and dub it back into other markets, and it ended up being essentially a global success. So this is a great thing for Netflix because it kind of shows them that well, this content might be, we might have made this specifically for a Korean market, but the world enjoyed Squid Game, and that's a positive thing. So when you're shooting films into, films and content and series into 40 different countries, and you have the power to be able to localize and dub this content back to other countries, it just the potential of another hit like that is just, it is just big. But lastly, Steve, I'll just give you this last little bit of information as well. I was looking at the churn rates of all of the streamers, and they're flat. And this would indicate that rather than being a sort of winner-takes-all kind of market, where, people gravitate to whoever has the best content and then they gravitate back if that company, stops producing great content, there's nothing like that. It's... the companies people just seem to be picking multiple streamers and kind of sticking with them. And this makes me think about 10, 15 years ago when I was with Sky TV and I absolutely hated it. And I said, you'd ring them up and you'd be like, look, I want the entertainment package, but I just want Sky One. I don't want all the other crap that comes with it. And, well, you can't have it. And if you have the entertainment package, you have to have movies. Do you know what I mean? And you ended up ringing up for basically wanting 6 channels and paying £70 a month for it. This Netflix, getting HBO, getting Netflix, getting Disney Plus, this is exactly what we've been asking to be able to do for years, and now we can do it. And that definitely feels to me like this is the reason why we have these churn rates.
Yeah, it's interesting, isn't it? So many markets appear to be the case of winner takes either all or at the very least the vast majority. So I think about battles between AMD and Intel in semiconductor space, and it's never been the case that they've both done well. It's the case that one or other of them has been putting the other one nearly out of business all the time, and right now it's AMD in the ascendancy, and before it was Intel, and no doubt it will swing back again and forward again and back and forward again. But it's always really interesting to find these cases, I guess, where there's opportunities for lots of different companies that are, in a sense, in competition. They are, if you think about these as advertising businesses, they are bidding for your viewing time and so on, but can still all kind of do well together. I guess that's an interesting sort of thing to think about here.
Yeah, absolutely. I've got a couple more little points that I've pulled out of interviews that were really very interesting. So, Ted Sarandos used to run a video rental company when he was a younger man, and they asked him what he took away from that, and he said, and this is an interesting point, is that offering a great recommendation to a customer was the best way to keep them loyal to you. They would keep coming back to ask you the same question. Ted Sarandos obviously being the co-CEO and head of content at Netflix as well. So, important little fact. And the other thing that really interests me is that Reed Hastings said that essentially the whole 18 to 49 market has switched from TV to streaming. So anybody looking to target 18 to 49-year-olds on terrestrial TV by making a TV ad has essentially lost a whole market that they're able to target. And this is his, he called it his blinkered situation, that he didn't realise that a lot of this market is on Netflix. So by introducing the ad-supported tier, he's almost giving them not unfettered access to 18 to 49-year-olds, but at least giving them a chance to be exposed to this kind of market that they want to target, that, up until fairly recently they've been able to get through terrestrial TV, that have slowly disappeared from terrestrial TV, and now Netflix is offering this, access to this, what is that, I assume, prime advertising market.
Yeah, and 18 to 49, two things about that strike me. One is that that's quite a large cohort of people. And the other is it's a pretty important cohort of people, right? These are the people who are going to be making decisions about what they watch and view and spend on, and forming habits in certain ways, for good or for bad, that are going to be around for some time. There's a kind of saying loosely somewhere that I would have looked up if I'd thought about this before, that says if you want to know what's going to be popular kind of in the future, go and look at what the teens are doing, basically, because they will be building out those kind of trends that will stick with you. So that's evidence of that comes from things like Lululemon, the enduring success of McDonald's, which appears to be popular with teens for all kinds of reasons. But looking at what the teens are doing seems to be important. The next bracket up, I guess, is 18 to 49, although it's a very big bracket and a very heterogeneous one. So I feel like that's an important kind of category for streamers in general and Netflix in particular to be kind of the main place to be looking at for these sorts of things. So I guess that should be important, right?
And look, it's a strange bracket, I must admit. I worked in advertising before, and I'm fairly certain we didn't have like 1 to 17, 18 to 49, and presumably 50 to dead. I mean, that is just it's such a strange, huge bracket.
Where you live, from 50 to dead might be one category, but yeah.
Yeah. But yeah, it is really strange, isn't it? But look, that's this is what Reed thinks, and this is why. If you wondered why Netflix were finally going into advertising, it was that. Netflix is the great pivoter, and this is a market that they have just discovered is like literally on their doorstep.
Finishing where we left it on that kind of point before about pivoting, I guess that's such an impressive feature, isn't it? I mean, the life cycle of companies, and so many companies go wrong by trying to pivot, right? They sort of fail to understand that they're aging and that they should be into a different kind of mode. They should be behaving like a Coca-Cola or something like that, of just keep supplying that demand that's there and distribute your earnings and push prices where you need to and try and keep moving your costs down and so on. I'm not saying don't innovate, but they don't try and do anything wildly different at Coke in any interesting way from what I can see. But Netflix does it so well. They keep pivoting. Microsoft is another example of something from what I can see that refuses to get old gracefully, but impressively, right? Sorry, go on.
Yeah, it's an admirable quality of a company of this size and this many employees to still be so agile. And this is something that we should really applaud Netflix. Is that literally 2 quarters of it, they weren't talking about an advertising tier. Then they said, hey, look, actually, you were right. We probably should look at an advertising tier. And then merely 6 or 8 weeks later, it was built and ready to ship, and they had a partner signed, and it was obviously partner signed was Microsoft, who Laura Martin at Needham's said the only reason they were doing that was to try and convince Microsoft to buy them, which seems to have been another 0.16 out of 5 call.
Yeah. I mean, eventually you would do better by just flipping coins, right? Statistically, and I'd say that as someone who has a stock sampler of 5 stocks, 4 of which are down quite significantly. 3 of which are down quite significantly, and 1 is flat. So not incredibly impressive stuff from me either. But I am not a professional analyst. I'm someone who you shouldn't listen to very carefully for stock advice, but you may or may not find the things I say interesting. Same goes for Steve, for what it's worth.